Welcome to the Rosenberg Roundup, a weekly podcast providing investors with key macro and market developments, insightful data analysis, and actionable ideas that are top of mind for the Rosenberg research team in the week ahead.
Let's go. I'm Dylan Smith, and this is the Rosenberg Roundup. As usual, I'm joined in the studio by Jacob. Jacob's the birthday boy today. I won't embarrass you, Jacob, by mentioning your age, but how was your celebration of another turn around the sun?
It was great, Dylan. Thanks for asking. I think I had enough cake that I'm finally in the inflation camp. So,
Yeah, well, you might be alone on that one, although recent data, there might be a few people joining you. But what do we have to chat about today?
well, we're going to look back on a big week of U.S. data that have moved the growth and inflation narrative along. We're going to briefly focus on what that means for the Fed's meeting next week, and then we're going to move a little bit beyond our usual scope, and we'll talk about Korea.
Excited for that one. Before we kick off, should we provide a quick overview of what's been happening in the markets this week?
Yeah, sounds like a good idea.
Cool. So really much the same as last week, really, at least in equities. Still kind of going sideways for most of the week, still at pretty high, pretty elevated levels, close to record highs. And sentiment measures, if you look at, the number of bulls versus number of bears reporting out there, still through the roof. So alongside that, there's plenty of evidence that profit taking is underway as the smarter investor crowd realizes that valuations are looking a little stretched. But the real action this week was in the bond markets. They were looking pretty steady until we got Thursday's producer price inflation number, which triggered one of the biggest sell-offs we've seen in a while, and we'll talk about that a little bit later on. Gold took a pause near record highs, with the Treasury move spilling over towards the end of the week and us seeing gold move down a little bit, but it's still looking pretty strong as a destination for those people exiting the equity market. And of course, Bitcoin's run of fresh highs continues as, traditional investors start piling into the ETFs, and there's a huge bit coming, so no end in sight to that. But we talked about that enough last week, so no Bitcoin this week, Jacob.
Well, thanks for that, Dylan. I think it's time that we move on to the week in review. Let's get into what was quite the busy week. Dylan, how about you start out by giving our listeners a quick update on your views right now?
Well, as we've discussed on the previous few pods, the price data is taking on an even more prominent role than usual in the narrative at the moment. And that's because the Fed's told us that they're basically ready to cut, but they want to see a couple more months of disinflation from the main price data before they pull the trigger, right?
Right. So do you think they got what they were looking for last month?
Not really. We had CPI and PPI this week. CPI came out on Tuesday a little hotter than expected, especially on the core front and the core services sub-index that the Fed tracks really closely, which popped a little bit. But that wasn't really enough to freak markets out. What did freak them out was the PPI number, which came in with basically the same message on Thursday. And I think the reason that there was such a strong reaction to that, as we said, a 10 basis point move in treasuries, is because it's got a little bit more of a leading indicator property. So that's telling us that PCEs at the end of the month, possibly even next month's inflation, is going to be a little higher than might have been priced before. So markets, the interesting thing is that they haven't repriced from a June meeting as the baseline for the first cut. So clearly they think there's enough time for us to kind of drive through this little inflation road bump before then, but not an ideal way to start the year on the inflation front.
So my understanding is the Fed actually prefers PCE inflation to CPI. And I think you mentioned we have PCE coming in at the end of the month. That's March 29th, right?
Yeah, that's correct. It tracks kind of real retail spending a little better than the CPI, which is why the Fed prefers it. You can get a very rough sense of what's going on in the PCE by looking at the CPI components and reweighting them. And that would point to headline PCE of around 2.5 to 3% at the end of the month. And anything lower than that would probably be dovish on the margin for the Fed. So that's where the focus will be inflation-wise.
Thanks, Dylan. Anything else you want to highlight?
Well, that was the inflation picture, but there was a lot going on the sort of real economy too, right? So the other big number was February retail sales data, also coming in on Thursday. And that was pretty bad. We're seeing a big pullback from the very hot Q3, Q4 numbers. The U.S. consumer, as we've written many times, will probably run out of room this year, and it looks like they've actually started fairly early. In real term, retail sales are falling compared to December quite significantly, and they're down compared to a year ago. And that brings us to something that I've been wanting to mention today, which is that, it doesn't feel like markets appreciate just how slow the start to the year has been in terms of the real economy data. It feels like there's this belief out there that we've had a few upside surprises in GDP. There's a lot of writing all over the place about how GDP just keeps on going and the US economy just keeps proving more robust. And I'm worried that, is leading people to be a little bit complacent. So here are a few data points that kind of tell you that we're in a different sort of world this year than we were towards the end of the last year. And, annual changes in a few series here. So we've got durable goods wholesale trade down almost 1%. Total home sales down 1.2%. Housing starts down 0.7%. Exports down 0.4%. Full-time employment, so not including part-time work, down 0.2% on the year. And real retail sales, as we mentioned, that's down 1.6%. So, the overall picture that's starting to emerge quite clearly is what academic economists call the sacrifice ratio getting worse. What that means in real terms is the Fed's going to have to start looking at inflation not being quite where they want it, maybe a little higher, but a real slowdown taking hold in the real economy that they're going to have to respond to. And so the calculus is starting to get shaped up to be a little different for them than just inflation. And it'll be interesting to see if we get some chat about that at next week's meeting.
Certainly. That's a pretty compelling list you just gave. Probably explains why the nowcasts for Q4 growth are much lower than what we're seeing as of late.
Yeah, exactly. And one more thing I'll point out, which we're really keen on here at Rosenberg Research, is the Beige Book, which is the report that comes out from the Fed's regional networks, where they literally go and just interview, small business owners and all the people kind of in their local network. And that provides a lot of sort of real-time anecdotal evidence of what's going on in the actual economy, separate and apart from the data, right? The traditional problem with that is that it's a very long written report, and you can kind of pull whatever quotes you want out of it. It's difficult to interpret. We have an in-house natural language processing tool that uses kind of machine learning and AI to get around that problem and create indices of what the Beige Book is actually telling us. And the thing to flag is that between the previous one in December and the most recent Beige Book a couple of weeks ago, services has absolutely collapsed, right? And that's important because services was sort of what's been keeping the economy really hot lately, as the goods side of the economy has been deflating and slowing down a little bit, and the global manufacturing recession has kind of been underway. So that's a good leading indicator that the weakness is transferring from the goods part to the services part, and it kind of tallies with what we're seeing in some of the other data that I mentioned.
Well, that was a lot of review, but it's all pointing to next week's big event, which is the Fed's March meeting.
Big event, but unfortunately, from our perspective, probably a bit of a snooze fest. The overall picture, which we've just discussed in quite a lot of detail, actually doesn't imply much for policy that is any different to what Powell recently spoke about in his recent congressional testimony, and it's not that different to what happened in the last meeting, right? So we don't think they'll want to rock the boat. They've been doing a lot of work managing expectations around when they're going to cut rates and so on. And so I think we'll get basically the exact same message we've been getting in the past few months from the Fed.
Right, so all quiet on the rates front. But didn't Chairman Powell promise something on QT?
He did, but all quiet on the QT front too. That was actually the title of a note that we put out this week. It is true that in January, Powell promised that the Fed, or the Federal Open Markets Committee, which makes the decisions, is going to be discussing QT in this meeting. But, although there is a building case for the Fed to start trimming the pace of purchases, this is a really difficult question for them, because he has to think about how markets would receive any change on the margin to the program, right? Markets are going to take it as dovish. Any slowdown in asset purchases, any announcement of when they would like to end or what threshold they'd like to end at is going to be seen as, okay, the Fed's in easing mode now, or it's reducing its tightness. And that could lead to a big risk-on surge, another fresh round of stock market highs, which makes it very hard actually to cut rates, which the Fed wants to be in a position to do in a few months. So he has to think very hard about how markets will take it, no matter what the sort of policy or academic case is on QT. And for that reason, we think that we're going to get very soft language around it. Yes, we spoke about it. Yes, the case is building for some adjustments, but no, we haven't made any decisions yet. Stay tuned for future meetings. That's kind of our baseline expectation there.
You can correct me if I'm wrong here, but I'm thinking that after going into 2024 with markets pricing a rate cut in March, it's actually shaping up to be the most boring meeting of the year.
Exactly that. Although remember, this is Chairman Powell, and the chance of a market-moving gaffe is not zero, so it's still worth paying attention to.
All right, Dylan, you've already flagged some of the writing we did on the U.S. this week, and we had a great special on the fiscal situation. We'll save that for next week, though. But the piece that caught my attention this week, it was focused a little bit further afield. Tell us a little bit about Korea.
Yeah, Korea. Well, Bhavana from our strategy team has done some excellent work looking into the Korean stock market. And that's in response to a lot of interest coming up on Korea, which actually really fundamentally stems from how well Japan's been doing. So we had Marius on last week to talk about our long-term bullish call on Japan. But just to remind listeners, Japanese equities are now up over 40% since the beginning of 2023. And a lot of that stems from reforms designed to force listed companies in Japan to create more value for shareholders, either through buybacks or productive investment, alongside an improvement in the structural macro picture.
Okay, so the idea is that Korea is on the same path here.
Exactly. Korea has announced something in the last little while called the Corporate Value Up program, which is basically a soft version of the Japan measures. And the interesting thing is that currently Korea trades at a massive discount. It's actually called the Korea discount to peers like Taiwan and Japan. And that discount is bigger than it usually is. So there's definitely some obvious short-term value on the table, and people are starting to sniff around Korea.
Okay, but if you had to choose, are you going with Korea or with Japan?
Well, still Japan, because there are some important differences between the Japanese program, which is much more advanced than the Korean program. First off, the Korean program has less teeth. It's completely voluntary, so it's not clear that they'll be able to actually enforce this value delivery for shareholders. Secondly, Korea's corporate structures are even more muddy and opaque than Japan's. There's complex holding structures which channel control of massive parts of the economy to a small group of families. That's called the chaebol system, and it's why Korea typically trades at this big discount. And finally, probably most importantly, there's an election around the corner, and that's going to be the real test of how serious this policy is as to whether it is continued and strengthened after the election. So for now, we love Japan, but we're recommending keeping Korea on your watch list. If you don't mind some election risk, they're probably worth a nibble on a short-term horizon, but don't go in kind of Japan style just yet.
All right. Well, thanks so much for that, Dylan. Looks like we made it to the end, but no Canada Corner. What's up with that?
Yeah, my favorite segment's out this week. Nothing going on in the north at all. Just a bunch of folks enjoying some unusually warm weather.
Well, I'm enjoying it myself. And on that note, maybe it's time to wrap.
Time to wrap. Next week, we'll be hosting a special guest from outside the firm to discuss the U.S. fiscal situation. But until then, I'm Dylan Smith. You are Jacob Rosenberg, as always, and that was the Rosenberg Roundup.
Thank you for listening to this week's episode of Rosenberg Roundup. For more information on our work and to take advantage of a free 30-day trial of our research, please visit rosenbergresearch.com. Make sure to tune in to our next episode for more insightful analysis on the macro and market landscape. Rosenberg Roundup is provided for general information and entertainment purposes only and does not constitute legal or professional advice, nor is it an offer to sell or a solicitation of an offer to purchase any security or derivative. Any views expressed by the participants of Rosenberg Roundup are solely their own and do not necessarily reflect the views, opinions, beliefs, or policies of Rosenberg Research.